Most investors assume the best opportunities appear when prices start rising. But in many cases, the opposite is where the real decisions are made. The uncomfortable truth is this: the moments that feel most uncertain are often the ones that reveal how people actually think about value. And right now, one part of the market is quietly sitting in that uncomfortable space. For the past few years, small-cap companies have been largely ignored, not because they stopped operating, not because they stopped earning money, but because they became less convenient to believe in. When interest rates rise and uncertainty increases, attention naturally shifts toward larger, more stable names. Companies that feel predictable, companies that feel safe. And in that process, smaller businesses are often left behind, regardless of whether their fundamentals change or not. This creates a pattern that repeats more often than most people realize. When conditions tighten, capital flows toward size and familiarity. When conditions loosen, attention starts drifting back toward what was neglected. It is not about sudden brilliance. It is about shifting perception. And that shift tends to happen quietly before it becomes obvious. Many people now look at small-cap stocks and see a simple story. They see lower prices, they see lower valuation multiples, and they assume that means opportunity. But that assumption is incomplete. A low price does not automatically mean value. It only means the market has decided for now to assign less confidence to that business. This is where the misunderstanding begins. A stock trading at a low price relative to its earnings can appear attractive on the surface. If one company is valued at 20 times earnings and another at 8 times, the instinct is to believe the second one is cheaper in a meaningful way. But the number itself does not explain why that gap exists. It only reflects that something about the business or its future is being questioned. Sometimes that skepticism is justified. A company may be facing declining demand, operational challenges, or structural changes in its industry. In those cases, the lower valuation is not a mistake. It is a reflection of risk. Other times, however, the skepticism may be broader than the actual situation. Entire sectors can fall out of favor even when individual businesses remain functional and profitable. The difficulty is that both situations look similar at first glance. This is why simply screening for cheap stocks rarely leads to consistent outcomes. It is not enough to identify a low number. The more important question is what that number is trying to signal. Is the market overreacting, or is it recognizing something real that has not yet fully played out? A more grounded way to approach this is to shift the focus away from price alone and toward durability. Instead of asking whether something looks cheap today, the better question is whether the business has the ability to continue producing earnings over time without requiring constant outside support. That distinction becomes especially important in areas like small-cap investing, where access to capital can change quickly. One of the most consistent patterns among disciplined investors is a preference for simplicity. Businesses that generate cash in a straightforward way tend to be easier to evaluate. Businesses that rely on uncertain outcomes, future approvals, or external conditions require a higher tolerance for unpredictability. Neither is inherently wrong, but they demand different ways of thinking. Consider a small company operating in a specialized field, generating income not by selling its own products directly, but by receiving a share of revenue from partnerships. On the surface, it may not appear impressive. There may be no recognizable brand, no dominant market position. But if that structure allows the company to produce steady income while funding future development, it changes the nature of the risk. It becomes less dependent on a single breakthrough and more anchored in ongoing activity. At the same time, that does not eliminate uncertainty. In industries like biotechnology, outcomes can shift quickly. Research pipelines may take years to materialize, and not every project reaches completion. The presence of current earnings does not guarantee future stability. It only provides a starting point for analysis. This is where the idea of cheap for a reason becomes more nuanced. Sometimes the reason is temporary. Sometimes it is structural. And the difference between the two is not always clear in the moment. Another example appears in industries tied closely to external forces, such as energy. A company providing services to energy producers may show strong performance when conditions are favorable. Rising demand can increase activity. Higher prices can justify expansion, and earnings can improve quickly. But those same factors can reverse just as fast. What appears strong in one quarter may look very different in the next. In these cases, valuation metrics can be misleading if they are taken in isolation. A low price relative to earnings may reflect a peak rather than a baseline. If the underlying conditions shift, those earnings may not persist, and what seemed inexpensive may turn out to be a temporary snapshot rather than a durable trend. This is why context matters more than numbers alone. Even in more familiar industries such as consumer-facing businesses, the same principle applies. A well-known brand may experience declining sales, reduced customer traffic, or increased competition. The market may respond by lowering its expectations. The stock price may fall, and the valuation may compress to levels that appear unusually low compared to historical averages. At that point, the conversation often shifts toward whether the situation has gone too far, whether the negative sentiment has fully captured the reality, whether there is room for recovery. But those questions are not easy to answer. They depend on factors that are not always visible in financial statements alone. Changes in consumer behavior, shifts in spending patterns, and broader economic conditions all play a role. And perhaps most importantly, timing remains uncertain. This leads to a core principle that tends to separate thoughtful decision-making from reactive behavior. Price is what attracts attention, but process is what determines outcomes. Focusing only on what looks cheap can lead to a cycle of chasing declines without understanding their cause. Focusing on how a business operates, how it generates income, and how it adapts to change provides a more stable foundation. That does not remove risk, it clarifies it. In periods where certain parts of the market have been overlooked, it is natural for interest to return. The idea that smaller companies may respond more quickly during a broader recovery has some historical support. They often have more room to expand. Their valuations may have already adjusted downward, and shifts in sentiment can have a larger relative impact. But none of that guarantees a specific outcome. The challenge is not identifying where attention might move next. The challenge is understanding whether the underlying businesses can support that attention once it arrives. This is where patience becomes more valuable than prediction, because in the end, the market does not reward what looks cheap. It rewards what continues to work over time. A useful way to think about this is to separate two ideas that often get mixed together: recovery and resilience. A recovery is what people hope for when they see a beaten down stock. Resilience is what determines whether that recovery can actually hold. And those are not the same thing. A company can recover in price without improving in substance, especially if broader market sentiment shifts. But if the underlying business remains fragile, that recovery may not last. On the other hand, a business that remains stable, even when its stock price declines, may be building the foundation for a more durable outcome. The difficulty is that resilience is quieter. It does not always show up in headlines or short-term movements. This is where a more structured way of thinking becomes useful. One practical framework is to ask a simple sequence of questions, not about where the stock might go next, but about how the business functions under pressure. Does it generate cash without relying heavily on external funding? Does it have flexibility to adjust when conditions change? Is management responding to challenges with clear actions or simply waiting for conditions to improve? These questions are not complicated, but they tend to reveal more than surface-level metrics. Take, for example, a company that operates in a cyclical industry. When demand rises, performance improves quickly. When demand falls, the same business may struggle. If that company also carries significant debt, the pressure becomes more pronounced. In strong periods, the leverage can amplify returns. In weaker periods, it can restrict flexibility. Now consider how that interacts with valuation. A low price-to-earnings ratio might look appealing during a strong phase. But if those earnings are tied to favorable conditions that may not persist, the apparent discount becomes less meaningful. The number reflects a moment, not a full cycle. This is why experienced investors tend to look beyond single-year performance. They focus on how a business behaves across different environments, not just when things are working, but when they are not. Another framework centers on incentives and control. When a company faces declining performance, the key question becomes whether management can influence the outcome. Some challenges are internal. Costs can be reduced, operations can be streamlined, underperforming segments can be adjusted or removed. These are areas where decisions can create change. Other challenges are external. Shifts in consumer demand, changes in regulation, broad economic slowdowns. These are factors that management can respond to, but not control. And when a business is heavily exposed to external forces, its path becomes less predictable. This distinction matters because it shapes expectations. If a company's performance depends largely on external recovery, then the investment thesis is tied to factors outside the business itself. That does not make it invalid, but it increases uncertainty. If instead the company has multiple levers it can pull internally, the range of possible outcomes becomes more manageable. Consider a consumer-facing brand that has seen declining sales. The immediate reaction may be negative. Lower traffic, weaker revenue, and reduced margins all point in the same direction. But within that situation, there may still be elements of control. The company might close underperforming locations, adjust pricing strategies, focus on more profitable segments, expand in markets where demand remains stable. These actions do not guarantee a turnaround, but they demonstrate that the business is not entirely passive. At the same time, it is important to recognize the limits of these actions. If the broader trend is working against the company, improvements may take time, and during that time, the stock price may continue to reflect uncertainty. This is where many people struggle. The instinct is to look for clear signals, a definitive bottom, a confirmed recovery, but markets rarely provide that kind of clarity in real time. Instead, they move through phases of uncertainty where both positive and negative outcomes remain possible. In those moments, decision-making becomes less about certainty and more about probability. One of the most consistent approaches in this context is to avoid relying on a single outcome. Instead of assuming a recovery will happen, it is more useful to consider a range of scenarios. What if conditions improve gradually? What if they remain unchanged? What if they worsen before stabilizing? Each scenario carries different implications for the business. By thinking in ranges rather than absolutes, the analysis becomes more grounded. This approach also helps address one of the most common behavioral patterns in markets, the tendency to anchor on recent price movements. When a stock has declined significantly, it creates a sense that it is due for a rebound, but price alone does not create value. It only reflects the current balance between buyers and sellers. A decline can continue if the underlying concerns persist, and a recovery can stall if expectations become too optimistic too quickly. This is particularly relevant in sectors that attract attention during periods of change. When a narrative gains traction, whether it is about small-cap recovery energy demand or consumer spending, it can influence behavior across a wide range of companies. Some will benefit directly. Others may move simply because they are associated with the theme. The challenge is distinguishing between the two. This is where simplicity becomes an advantage. Businesses that generate earnings in a straightforward way are easier to evaluate under different scenarios. Complex structures, multiple dependencies, or uncertain timelines introduce additional layers of interpretation. Each layer increases the potential for error. That does not mean complex businesses should be avoided. It means they require a higher level of scrutiny. Another important aspect is time horizon. Short-term movements are often driven by sentiment, news flow, and positioning. Longer-term outcomes are driven by the ability of the business to sustain and grow its earnings. When these two forces align, the result can be strong performance. When they diverge, the experience can be uneven. Many of the situations discussed earlier fall into this category. A company may appear undervalued based on current metrics. It may benefit from improving sentiment, but if its long-term earning power remains uncertain, the path forward may not be smooth. This brings the focus back to the original idea. The opportunity in overlooked areas of the market is not simply that prices are lower. It is that attention is limited, and limited attention can create gaps between perception and reality. But those gaps are not always in the same direction. Sometimes they reflect pessimism that is too broad. Other times, they reflect optimism that has not yet been tested. The task is not to assume one or the other. It is to examine what is actually happening within each business and that requires a certain level of discipline because it is easy to become influenced by narratives, especially when they are widely repeated. The idea that smaller companies will lead a market recovery may turn out to be correct in some cases, but it is not a rule. It is a possibility, and treating it as a certainty can lead to decisions that are not fully supported by underlying facts. In the end, the goal is not to predict which part of the market will move first. It is to understand which businesses are capable of sustaining their performance regardless of how sentiment shifts. That is a quieter objective, but it tends to be more reliable over time. Even with a structured way of thinking, there is one part of the process that cannot be removed: uncertainty. Every business, regardless of size or sector, operates within conditions that can change. The difference is how sensitive that business is to those changes and how prepared it is to respond. This is where risk needs to be discussed directly, not as a disclaimer, but as part of the analysis itself. In smaller companies, one of the most common risks is dependence. Dependence on a single product, a single customer, a single source of income. When that concentration exists, outcomes can shift quickly. A delay, a disruption, or a change in demand can have an outsized impact. Larger companies often have diversification that absorbs these shocks. Smaller ones may not. Another risk comes from access to capital. In favorable conditions, raising funds can be relatively straightforward. In tighter environments, that same process becomes more difficult and more expensive. Companies that rely on external funding to sustain operations or growth may find themselves under pressure if those conditions change. This is particularly relevant in industries where development cycles are long and uncertain. There is also the issue of timing. Even when a business is fundamentally sound, the path from recognition to realization is rarely direct. A company may improve its operations, stabilize its finances, and position itself for growth. Yet the market may take time to reflect those changes. During that period, prices can remain stagnant or even decline further. This creates a tension between patience and conviction. Without patience, the process is interrupted before it has time to play out. Without conviction, it becomes difficult to stay aligned with the original reasoning when conditions feel uncomfortable. And both of those elements are tested more heavily in areas of the market that are less stable. External factors add another layer. In sectors tied to global events such as energy outcomes, can be influenced by variables that are difficult to predict. Changes in supply shifts in demand, geopolitical developments, and policy decisions all interact in ways that are not always linear. A favorable trend can reverse quickly. A negative trend can stabilize without warning. For companies operating within these environments, performance may not follow a smooth trajectory. Periods of strong results can be followed by periods of adjustment, and valuation metrics which rely on current or recent data may not fully capture those dynamics. Consumer-driven businesses face a different type of uncertainty. Changes in spending behavior can happen gradually, but their impact can be significant. When consumers become more selective, discretionary spending often declines first. Companies that rely on frequent low-cost transactions may feel that shift quickly, and once habits change, they can take time to reverse. In those situations, management actions can help, but they may not be sufficient on their own. Improving efficiency, adjusting pricing, and refining operations can stabilize performance, but broader demand trends still play a central role. This is why it is important to avoid a single narrative when evaluating these cases. A company can appear undervalued based on historical comparisons. It can show signs of operational improvement. It can attract renewed attention due to broader market themes, and still the outcome may depend on factors that are not entirely within its control. Recognizing that complexity does not eliminate opportunity, it simply places it in context. There is also a psychological dimension that often goes unspoken. When a stock declines significantly, it creates a perception of risk that is tied to recent experience. The memory of loss becomes part of the decision-making process. At the same time, the lower price creates a perception of opportunity. These two forces operate together, often leading to conflicting instincts. This is where many decisions become reactive. The idea of catching a falling price can feel appealing because it suggests buying at a better level. But without a clear understanding of why the price is falling, that approach becomes speculative. The decline may be temporary, or it may reflect a deeper issue that has not yet been resolved. On the other side, waiting for clear confirmation can reduce uncertainty, but it may also mean accepting a higher price later. There is no perfect balance, only trade-offs. One of the more consistent ways to navigate this is to focus less on the exact entry point and more on the overall reasoning. If the understanding of the business is sound, small variations in timing become less critical. If the understanding is incomplete, even a well-timed decision can lead to unexpected outcomes. This brings the discussion back to a central idea. Markets often move based on attention before they move based on fundamentals. Narratives form, capital shifts, prices respond. But over longer periods, the ability of a business to generate and sustain earnings becomes the anchor. This does not happen immediately, and it does not happen in a straight line, but it tends to be the factor that remains when other influences fade. So, when looking at areas that have been overlooked, the key question is not simply whether they will attract attention again. It is whether the businesses within those areas are positioned to justify that attention over time. That is a more demanding standard, but it is also a more stable one. In practical terms, this means accepting that not every low valuation represents an opportunity. Some reflect real challenges that may persist. Others reflect temporary dislocations that may correct. Distinguishing between the two requires more than surface-level analysis. It requires an understanding of how the business operates, what drives its earnings, and how it responds to change. There is no shortcut for that process, but there is a benefit, because once that level of clarity is established, decisions become less dependent on short-term signals. They become anchored in a framework that can be applied across different situations. And that is where consistency begins to emerge. A lower price does not create value on its own, it creates a question, and the quality of the outcome depends on how that question is answered. By focusing on durability, understanding the sources of risk, and separating perception from reality, it becomes possible to approach these situations with a clearer perspective, not with certainty, but with structure. If this way of thinking helps clarify how to approach uncertain markets, consider applying the same framework to other areas that feel overlooked or misunderstood. The goal is not to predict the next move, but to build a process that holds up regardless of what the market does next. Over time, that approach tends to matter more than any single decision.